Hello everyone. We're going to discuss trailing stops in this video. How do you trail a stop? As part of the mentorship program, it's important to know how to trail a stop, especially when the conditions are right. You can't trail a stop on any type of trade, so there's going to be specific reasons and specific methods that are going to trail a stop better than others. So take for example the roadmap. The roadmap trade is typically the start of something. So the start of something would be as the market begins to move, let's say up as a new direction. Let's say this is a roadmap. This is a perfect opportunity to trail a stop. Now at the open trades, maybe blueprint trades, they are not as good because possibly the move is halfway into its lifespan. So we want to be able to trail a stop at the beginning of a move like the roadmap, maybe even the X5. Now, typically, trailing a stop means that there's some type of a trend. Trends usually occur under more volatile conditions. So if the market is slow, 1 point, 1.5 points, I would say to you the chances of the market going somewhere or doing something are probably less likely. Now, when the market is a little bit more volatile or even normal, let's say 2 points, 2.5 points, 3 points on the ATR down here, I would say to you, more likely than not, the market's going to move and continue. It's not going to be this tight whipsaw channel range. So a trailing stop should be implemented when you have, I would say, normal or more higher than normal volatility. And also on the methods that we've learned, I would definitely prefer to use it on something like the roadmap or the X5 as opposed to the at the open or the blueprint. The Alice line is good for trailing stops if you catch it at the beginning of a move closer to the Atlas line as it begins up or begins down. So the way that I like to trail a stop would be to start off not with one contract but with two or multiples of two. So 2, 4, 6, 8, 10. So when I look at using two contracts, this would entail entering with two contracts, 4, 6, 8. So we're going to start off with something very simple. You still have to have the same stop on both contracts initially. What differentiates the trailing stop is as it starts to move, we're going to exit or take half of the position off of the trade. So it could be 2, 4, 6, 8, 10 when you get there. Not that I want anyone to trade 10 contracts initially. Start off very slow, small practice. Remember, trading is risky, so we don't want to jump in. We want to be well versed and well practiced before you start to go heavy. So let's say, using numbers that are easy to calculate, let's say the entry is 21.76, two contracts. The ATR is going to be, let's say, again, to keep it simple for the basis of math, 2 points on the ATR. Okay, now entering with two contracts or multiples of two, we'll say two contracts, when the market begins to move in your favor, it's a long position, it's a roadmap, the market has come down and now it's in that roadmap area as expected. It's now beginning to turn around and pivot, reverse, be manipulated off of this roadmap. As soon as the market makes 1 times the ATR, so in this example 21.78 would equal 1 times the ATR, what we're going to do now, remember, and the stop, by the way, is either the pivotal stop or it is the 3 ticks on the other side of the buffer, right? So the stops don't change. You just have to have a stop that is equivalent to how many contracts you go in with. 2, you have to have the stop for 2. 4, you have to have the stop for 4. So the stop being down here, let's say it's down here somewhere, right? The stop, and let me just change this color, make it nice and red. So the stop doesn't change. But what does change is that when the market makes 1 times the ATR, ATR being 2 points, 2178 was 1 times the ATR, exit half of your position. Exiting half of the position at 1 times the ATR. Now the reason why I'm doing this is instantly I'm locking in the trade to a $0 trade. I'm not going to lose money on this trade. I just have to pay for the commissions in case the market turns around and goes against me. But essentially, I am exiting half of my position. If I'm starting off with 2 contracts, I have 1 left. And that 1 contract, the one that's left, is the runner. So here is 2178, 1 times the ATR, exit half your position. Now the goal is to see the market go 2 times the ATR or 3 times the ATR. And especially if you enter at the beginning or early on as the move begins, like the roadmap typically does give that to you, you have a larger chance of letting it ride. But you can't really trail a stop right at the end of a trend, because at any point in time it could just reverse on you and there goes the whole trailing stop out the door. So that's why I'm suggesting using something like the roadmap. So 2 times the ATR, 3 times the ATR, it's possible. Now that I've taken half off, half of the position off, this stop no longer stays the way it is. This stop is now going to be changed. First, if you have 2 contracts, this has to be changed to reflect however many contracts you now have. So if you start off with 2, you took half off at 1 times the ATR, it's got to be changed to 1 contract for the stop. Right? You're not going to keep it at 2, you got to change it. Now if you made 2 points from 2176 to 2178, you took half off, the stop is now going to be updated on this 1 remaining contract, half of your position. It's going to be updated now equal to the profit you made. So if you made 2 points, you're going to put your stop equal to where you entered minus 2 points. So in this case, 2174 becomes your stop, 2 points from where you entered. Here's the rationale behind this. If you allow the market a tight stop, which most traders like to do, they like to have a nice tight trailing stop. I already know based on the ATR that the market could go up 2 points, it could also go down 2 points. That doesn't really help me if I'm trying to trail a stop. It could very easily stop me out unnecessarily, only to see the market continue. So I am going to give this a total of 4 points from where it's at in order to breathe. So my stop is changed from where it started off. It's adjusted to be 2 points from where I entered. I made 2 points. If the market happens to crash and come all the way down to 2174, I'm out. And what I win or lose is actually $0. I don't make any money. I don't lose any money. I made 2 points. I lost 2 points. I just have to pay for the commission. Now, you may think that's not a good deal, but remember, most traders, when they attempt to trail a stop, they either mess it up, they lose money, they have it too tight, so they give it back unnecessarily. I'm giving this a chance to work. I really want to see the market grow. And so I have to have a stop that is larger than the ATR. Now, as you go forward in time, let's say that it continues. So it flops around here a little bit. Maybe it could even possibly, right, come down to where you entered, this 1 remainder contract. But then eventually, without stopping you out, it goes to 2 times the ATR. this runner, this remainder half of your position, is going in your favor, you have to update now the stop. So the stop was 4 points. I'm going to adjust the stop, still being 4 points from where the market is currently trading, 2 times the ATR. I just move my stop up. If the market moves to 3 times the ATR, I adjust as well the stop in the same fashion. So I'm always behind the market 2 times the ATR in order to let this runner breathe. Now, I know that many of you want to have this 20 or 30 or 40 point trailing stop scenario, right? Everybody wants that, but it's not relative. It's not a reality. It's not a reality because once the market begins to move 2 times the ATR, 3 times the ATR, even sometimes 4 times the ATR is doable. But at any point in time, this can reverse on you fast and hard, and you're giving back, in essence, in this example, 4 points. With a trailing stop, you can't think of every single day or every single trade as the home run $1 million trade. Once the market moves 2 or 3 times the ATR, consider exiting that half of your position, the remainder half of your position, and being done with it and wiping your hands clean, taking the money and run. And I'm saying that because you're looking at 2 points on one contract, and then you're looking at, let's say, 6 points on your runner. That's 8 points total. Now, I don't know about you guys, but I think 8 points is fantastic. Even 6 points is fantastic on one trade. So don't look for it to move that 30-point day where it's just going to keep on going and going. They're very few and far in between, and typically they don't occur when you want them to occur. Or the market may be very volatile, and you have to have very large stops. Now let me give you another example. The ATR, instead of being 2, let's say the ATR is 3. A little bit more active, 3 points on the ATR. We're going to use the same values, 2176. Once the market makes 1 times the ATR, that would be the equivalent of 2179. So 2179, 1 times the ATR, half your position comes off. You're left with the remainder half of your position. Your stop initially was what the stops are with the roadmap or any other type of method, but as we start to continue to see the market move higher, 1 times the ATR, this becomes a break-even trade. 3 points from where you entered is now where you bring up your stop. So 2176 to 2173 happens to be your stop. You made 3 points. If the market comes all the way back down to here, which would be 6 points, you are out of the trade. $0 once again. You just got to pay for the commission, however many contracts you trade. Now 2 times the ATR would happen to be 2181. I'm sorry, 82 if my math is right. 82. So 2 times the ATR, 2182. 3 times the ATR, 2185 up here. Now 3 times the ATR, again I suggest get out, take your money and run. You're looking at 3 points on one contract, 9 points on the runner, 12 points. Not too shabby, not too bad. Why risk it and see the market come back and stop you out? Just get out of the trade. So every time the market moves 2 times the ATR, you move your stop up. 3 times the ATR, move your stop up, and I would take profit. So that's how I recommend trailing stop. It's hard to do with just one contract because really the idea is to create a break-even trade as soon as possible. Not necessarily a break-even trade, but a trade that is going to not cost you loss. Commission, a couple dollars, not the end of the world if it loses out. But in this case, the market makes 3 points, immediately move your stop 3 points in the opposite direction. You have nothing at this point to lose or really to worry about if it does stop you out. 2 times the ATR, 3 times the ATR, exit. If you have any questions, feel free to email me, support@DayTradeToWin.com. I hope this trailing stop video helps you. I look forward to hearing from you.